Welcome to The Explainer. Today, we're taking a seriously fascinating journey into the evolution and the everyday mechanics of the stock market. We're going to completely strip away the confusing Wall Street jargon, trace this thing right back to its historical roots, and visually map out exactly how this massive global financial engine actually works. Let's dive right in.
So how exactly did 17th century spice ships invent modern finance? I know, it sounds almost like a riddle, doesn't it? When we think of the stock market today, we immediately picture, digital screens flashing green and red, chaotic trading floors in New York or Tokyo, and massive tech conglomerates. But to truly wrap our heads around the mechanics of how it all functions today, we actually have to travel back in time. We need to look at a story of shared risk, high adventure, and incredible reward.
Picture this. Our story kicks off back in the 1600s. During this era, the Dutch East India Company was running a massively ambitious operation. They employed hundreds of ships, sending them all across the globe to trade highly valuable goods, stuff like gold, porcelain, spices, and silk. But sailing in the 17th century? Incredibly perilous. Between deadly storms, pirates, and widespread disease, losing a ship meant absolute financial ruin. Running a global fleet like this was just profoundly expensive, and the risk was off the charts. By the 1610s, the company realized, okay, we need serious funding to keep these expensive voyages going and to spread out all that immense risk. So what did they do? Well, by the 1620s, they turned to everyday private citizens, literally asking individuals to invest their own personal money to support the trips.
Now, this wasn't happening in some fancy, formal building with a ringing bell. Not at all. The Dutch East India Company was out there selling shares in bustling, smoky coffee houses and loud shipping ports all across the continent. Citizens would literally hand over their cash to fund the voyage, and in exchange, they were promised a cut of the ship's profits when, or really if, it returned. Think of it as the 17th century equivalent of angel investing in a super risky tech startup. Except instead of a software bug tanking your investment might literally be eaten by a kraken or sunk by pirates. This simple, brilliant little practice allowed the company to afford even grander voyages, increasing profits for everyone involved. And, completely unknowingly, they invented the world's first stock market.
Fast forward to today. Since those days haggling in the shipping ports, the market has evolved into this massively complex system. But here's the secret. The core mechanic remains exactly the same. Today, the stock market is so vast, it's got entire schools, lifelong careers, and 24/7 television channels dedicated entirely to understanding it. So how do modern companies and investors actually use this thing? Let's imagine a brand new, modern coffee company that decides, you know what? We want to launch on the market.
Here is exactly how that coffee company actually makes it onto the stock market. Step 1. The company goes out and advertises itself to big institutional investors. If these large investors look at it and think, yeah, this company is a great idea, they get the first crack at investing. That brings us right to step 2. These early investors sponsor the company's initial public offering, or IPO. This is absolutely crucial. It's the moment where a completely private company steps out into the public spotlight. And finally, step 3. This IPO officially launches the company onto the broader public market. The doors are thrown wide open. Any individual or any company who believes this coffee business has what it takes to be profitable can jump right in and buy a stock.
Now, buying stocks makes investors partial owners in the business. I really want you to let that sink in for a second, because it is the fundamental core of this entire system. When you buy a stock, you aren't just making some arbitrary digital transaction or placing a bet on a random ticker symbol. No. When you buy that coffee stock, you essentially own a tiny, literal fraction of their espresso machines, their coffee beans, and their brand. Your investment is actively helping that company grow. You're holding a tiny piece of that company's actual future right in your hands.
And this dynamic creates the ultimate seesaw of supply and demand. On one side, as a company succeeds and hits its targets, more buyers see its potential and want to get in on the action. Demand increases, and naturally the stock price rises right along with it. This raises the value of the stocks people already own. But if the company hits a rough patch and starts to seem less profitable, the exact reverse happens. Investors get spooked, they sell off to protect their money, demand drops, and the stock price falls right along with the company's overall market value.
Let's look at the good side of that seesaw first. When demand for a stock goes up, it is a fantastic scenario for the business itself. This increased public interest actively helps fund brand new initiatives for the company. It literally gives them the capital they need to innovate, expand into new markets, and hire more people. Furthermore, a high stock price boosts its overall market value. It serves as this incredibly powerful, very public signal showing exactly how many people are willing to put their hard-earned money on the line to validate the company's core idea.
However, the reality of the market is that it swings wildly in both directions. If investors start to even just think their stock value is going to decline, fear sets in, and it sets in fast. They'll start selling off their stocks with the hopes of making a quick profit or sometimes just to cut their losses before they think the company goes completely under. This decreased profitability causes panic selling, and once that fear takes hold, man, the sell-off can be incredibly fast. As overall demand plummets, the actual stock price falls, leaving any remaining investors with massive financial losses, unless the company can somehow pivot and start to look profitable again.
So what actually causes that sudden panic? Well, welcome to the Daily Market Noise. Real-world companies are constantly battered by a relentless storm of variables. We're talking fluctuating material prices, new production technologies disrupting the industry, labor shifts, or even just a CEO having a really bad PR day. On top of all that, investors constantly worry about sweeping macro factors, things like new laws and shifting international trade policies. Plus, you have to remember, plenty of investors might just be ready to sell their valuable stocks to go pursue personal interests, like buying a house or retiring. All of these chaotic, unpredictable factors crash together every single day.
Because of all that daily noise, the stock market ends up being heavily influenced by psychology and perception. In the market, simply appearing to lose value often leads to losing real investors, which in turn causes an actual loss in real value. It's the ultimate self-fulfilling prophecy. The day-to-day noise can make a company just appear slightly less successful for a fleeting moment, but if enough people believe that appearance and hit the panic sell button, the company's market value truly, literally tanks.
Which brings us to an incredibly profound realization from our source material. Quote, "Human confidence in the market has the power to trigger everything from economic booms to financial crises." Let that sit with you for a moment. Despite all the insanely complex algorithms, the sophisticated mathematical models, and the advanced trading software running constantly out there, the core engine of the stock market is still driven by a difficult-to-track, inherently messy variable: human emotion. Confidence builds empires, and panic can tear them down overnight.
It is exactly because of that messy human unpredictability that professionals approach the market in a very specific way to survive this emotional roller coaster. Basically, it comes down to reliable long-term investing versus trying to make quick cash. Most financial professionals heavily promote the long-term approach, while experts are constantly building new tools to try and increase their chances of success. Trying to time the market for a quick buck in such a highly unpredictable system, it's just incredibly risky. Playing the long game allows investors to ride out the daily noise and survive those inevitable, massive waves of human confidence. Now, historically, you might look at this massive, complicated system and think, well, it's really only for wealthy elites or Wall Street insiders, right? But the dawn of the internet actually sparked a profound historical shift, completely democratizing the stock market. The market is no longer just a walled garden for the rich and powerful. Today, everyday investors can literally open a web browser or just download an app on their phone, and suddenly they have the exact same ability to buy stocks in many of the exact same ways a massive institutional investor would. The playing field has been fundamentally changed forever.
And because of this shift, you have unprecedented power. You can educate yourself about this complex system, just like you're doing right now with this explainer. You can independently trade stocks. You can put your money where your mouth is and actively support the businesses you actually believe in, becoming a partial owner in their vision. And honestly, most importantly, you can use this historic system to pursue your own personal financial goals, totally on your own terms. So now that you understand the underlying mechanics, from the wild risk-sharing of 17th century spice ships to the modern IPO, from the seesaw of supply and demand all the way to the immense psychological power of human confidence, you know exactly how the machine works. You know that investing isn't just about making a quick buck. It's about fundamentally supporting the businesses you believe in. It's about funding the ideas, the products, and the services that you actually want to see thrive in the real world.
The first step really is simply getting invested. You now hold the exact same power as those ambitious 17th century merchants, but literally from the palm of your hand. So as you look at the world around you today, ask yourself a question. Which ideas will you choose to fund tomorrow? Thanks so much for joining me on this explainer, and keep exploring.